Everyone tells you to open a Roth IRA, your coworker, your Reddit thread, the guy with the ring light and motivational poster behind him who calls himself a wealth coach. Open a Roth IRA, tax-free growth, tax-free withdrawals, it's basically free money. The government is practically giving you wealth. And you know what? They're not entirely wrong, but they are leaving out the part that turns this perfect account into a trap for the exact people it was supposed to help. Welcome to the Tough Finance. We don't sell you dreams, we show you the fine print they hope you never read. Let's start with the basics, because most people nodding along to Roth IRA advice couldn't actually explain what it is. A Roth IRA is a retirement account. You put money in after taxes, meaning you already paid income tax on it. It grows inside the account completely tax-free, and when you retire and pull it out, you pay zero taxes on it. Not on the gains, not on the growth, nothing. Compare that to traditional IRA or 401k, where you put money in before taxes, get deduction now, but pay taxes when you withdraw in retirement. The Roth sounds better, right? Pay taxes now while they're low, avoid taxes later when your account has grown. And for a lot of people, it genuinely is better. But here's where the story gets complicated and expensive. The Roth IRA has income limits, and nobody in a highlight reel of financial advice talks about this enough. In 2025, if you're a single filler earning more than $165,000 a year, you cannot contribute to the Roth IRA. Full stop. The government decided you're too rich for this particular gift. If you earn between $150,000 and $165,000, you can contribute a reduced amount, a partial contribution that phases out as you earn more. Under $150,000, you're fine. Full contribution up to $7,000 a year, $8,000 if you over 50. Now you might be thinking $165,000 is a lot of money. Most people earn less than that, so what's the problem? The problem is this limit doesn't scale with the inflation automatically in a way that protects you. The problem is that $7,000 annual contribution limit is genuinely tiny when you're trying to build retirement wealth. And the biggest problem is what happens to people who do everything right, max out their Roth every year, watch it grow, and then discover decades later that they built their entire retirement strategy on one assumption that turned out to be completely wrong. Here's the core lie buried in a Roth IRA pitch. The entire argument for the Roth over the traditional IRA rests on one assumption, that your tax rate in retirement will be higher than your tax rate today. Pay taxes now at your current rate, avoid taxes later when you would owe more. That logic is sound if the assumption is correct, but think about that assumption for a second. You are betting with decades of your retirement saving that the tax rate in 30 years will be higher than they are today. You are making a political prediction about the future of the US tax code and stacking your financial security on it. Taxes rate has gone up, they're also gone down. The current tax cuts from 2017 were extended, but nothing is permanent. Nobody, not even your wealth coach, not your Reddit thread, not the guy with the ring light, knows what taxes will look like in 2045 or 2055. And here's the other side of that gamble. Most people in retirement actually spend less. Their income drops, their tax bracket drops with it, which means a traditional IRA paid taxes later at a lower rate could actually beat the Roth for a huge portion of the population who were told the Roth was always the smarter move. This isn't a reason to avoid the Roth, it's a reason to stop treating it like a universal truth handed down from the financial heavens. Remember those income limits we talked about? Here's something the financial industry whispers to rich clients but never shouts to everyone else. There's a loophole. It's called backdoor Roth IRA. It works like this: you contribute to a traditional IRA, no income limits on contribution, just on deductions. Then you immediately convert that traditional traditional IRA into Roth IRA. You pay taxes on the conversion and boom, you're in a Roth with no income limit violation. It is slightly complicated, yes. Does it require some paperwork and potentially an accountant? Yes. Is it completely legal and used by millions of high earners every year? Absolutely. The fact that this strategy exists is barely mentioned in the mainstream financial content. Tells you everything about who that content is actually written for. It's written for the people who will click, feel informed and not dig deeper. Not for the people who actually need the most efficient path to build wealth. That's what we're here for. Let's zoom out for a second. The Roth IRA is genuinely useful tool. So is traditional IRA, so is 401k. But the entire retirement account industrial complex is built on one quietly terrifying premise, that you should lock your money away for 30 or 40 years. Trust the tax code won't change. Trust the market will be higher. Trust that you'll be healthy enough to enjoy it, and trust that the rules about when and how you can access it won't shift underneath you. You can't touch your Roth earnings before 59 and a half without a penalty. Yes, there are exceptions, but the default is the money is locked in an account for decades while life happens around you. The financial industry loves retirement accounts because they create long-term captive asset under management. Every dollar you lock in a Roth is a dollar that stays in a financial system generating fees, commissions and investment products for someone else. That doesn't mean you shouldn't use them. It means you should use them with your eyes open, as one tool in a broader strategy, not as the entire strategy sold to you by someone whose business model depends on you never questioning it. So what do you actually do? If you're under the income limit, open a Roth IRA and max it out every year. That part of advice is correct, just don't stop there. If you're over the income limit, look at the backdoor Roth. It exists, use it. If you're trying to decide between Roth and traditional, stop looking for the universal answer. Run the numbers on your specific situation, your tax rate today versus your expected tax rate in retirement. Anyone telling you one is always better than the other is selling simplicity over accuracy. And if someone tells you a Roth IRA is basically free money from the government with zero downsides, ask them what happens if tax rates drop in 30 years. Watch them change the subject. This is the tough finance. The wasteland doesn't do easy answers. Subscribe because another video is coming and is going to make your financial influencer even more uncomfortable than this one did.